Hi everyone, I wanted to provide a short video tutorial related to Chapter 5, Homework Problems number 5 and 6. This has to do with the home sale. And when a taxpayer sells their home for a gain, what happens with that gain? Is it taxed or not? So to get our heads around this, let's first think about the concept of the gain, and then we'll look at the rules, the tax rules. So let's say that at one point in the past we bought the home for $200,000, okay? We now sell it for $500,000. That means we have a $300,000 gain, okay? Now that is the potentially taxable portion of this fact, okay, of this fact pattern, the $300,000 gain. Now the IRS has a rule that says, depending on what kind of filer you are, and let's just say that we're single filer for use of this example, what it says is we can take a taxable gain of $300,000 and exclude $250,000 of that gain if certain rules apply, okay? So this is the economic gain. This is the exclusion. Now, you have to satisfy the rules to avail yourselves of the exclusion. If you meet the rules of the exclusion, then your taxable gain would drop by $250,000 to only $50,000, okay? So we definitely want to understand, can we get that gain? Can we get that exclusion or not? Because that could have a huge impact on our tax return, right? Okay, so what we need to do is first of all, we need to understand these two rules. 2-year use test, 2-year home ownership test. And here's what the rule basically says. We work backwards from the sale date, okay? So let's say that we sold our home for the $500,000. That transaction happened on, let's say, December 1st of 2020. We have to have owned and used that home for at least 2 years out of the preceding 5 years. Okay? That's basically what these two rules, 2-year use test, 2-year ownership test say. Now, one way to think about that is, if we bought the home in 2019, then we automatically do not qualify for this exclusion, right? Because we have not owned and used the home for at least 2 of the last 5 years. Okay? So this 2-year, what we want to do is almost think 2 years backwards, and then, then there's a little bit more nuance related to that. So 2 years backwards. So basically, we had to have purchased the home at least December 1st, 2018 or prior. Okay? If we did, then that means that this 2-year period we would have owned and used the home. Now, there is an example in your book of a couple that have owned their home. They owned a home, but then they left it vacant. Okay, so they moved somewhere else and left this residence vacant for a year or two. That's an example of how they weren't living in the home for a year prior to sale, but in that example, and I'll just give you this heads up, they did own and use the home for more than 2 years out of the preceding 5. Okay, so there is some nuance here. What I want you to do is use slides number 17 and 18 in the book. I'm also providing an Excel sheet because I want to give you guys some spreadsheet experience where you can actually kind of layer in some of these facts with each example, okay? One final thought here that I wanted to share was this word up here called basis. Now, basis is kind of the cost of the home, okay? So I said cost before because I kind of wanted you guys to just think about how much did it cost the buyer initially to buy the home, and then they sell it later, and then you kind of can compute the gain. Well, we're going to learn when we look more at the sale of capital assets that this is called basis, okay? The cost to the buyer. What amount does the buyer have invested in the asset that they go to sell? And we're going to see that basis is the initial cost to acquire the asset, but then it can also be adjusted over time. And so we also have this idea of adjusted basis. I mention it really in the spirit of just looking ahead in the course at some of the other concepts we're going to look at related to capital assets, and again, a home is a capital asset, so it's one example.